Well, friends, we will solve one more funds flow statement problem. So let me read the problem. Here it is. From the following particulars, prepare funds flow statement and a statement of changes in working capital. So liabilities are given: equity capital, preference capital, debentures, and then reserves, provision for doubtful debts. See, provision for doubtful debts is there, and then current liabilities are there. Okay, fixed assets, investment, current assets, discount on debentures. A machine costing 70,000, book value of 40,000 was sold for 25,000. ಹಾಗಾದರೆ loss ಇಲ್ಲಿ 15,000. Preference shares are redeemed at a premium of 5%. Dividend at 15% was paid on equity shares for the year 2010. Provision for depreciation is 1,50,000 on 31st December 2010 and 1,90,000. So difference is 40,000. Then we have to see other things also, this machine and all. So 90,000 at 2011. Stock which is valued at 90,000 on 31st December 2010 was written up to its cost of 1 lakh rupees. So 90,000 1 lakh under 10,000 for preparing profit and loss account for 2011. So this is a problem. Let us start with our statement of changes in working capital, wherein we take all the current assets and we take all the current liabilities. So let us first take current assets. Sorry. So here it is. There is 2010 they have told that they have taken stock at 90,000, but actually it is 1 lakh. So that 10,000 you have to add here. So stock of 10,000 is added for 2010, so it becomes 250. And then 2011 we have 3,75,000, so it is an increase of 1,25,000. So increase in current assets leads to increase in working capital. So 1,25,000 is done. The total current assets we have to write, and then we will move on to current liabilities. I told in the format when we are doing statement of changes in working capital that provision for doubtful debts and provision for bad debts should be taken in current liability. So should be taken in current liability. So current liability, provision for doubtful debts we have to take. So we have taken provision for doubtful debts. It's 10,000 and 15,000. So increase in liability is decrease in working capital. So decrease in working capital of 5,000. Then again current liability is there, 70,000 1,45,000. So it is 75,000 increase. It is decrease here working capital. So total current liabilities we have to do. Deduct current liabilities from current assets. You will get net working capital. So net working capital of 80,160. So there is increase. So here also increase column you do. Increase here. Here also it is in decrease column also. Total should be done. So difference of 45,000. So that is a net increase in working capital. So this is a beginning statement. Then we have to do all ledger accounts for adjustments. So fixed assets, there is adjustment of machinery. So here it is fixed assets 5 lakh 10,000, that is net they have given. So depreciation you have to add of provision for depreciation of 1,50,000. So 660 becomes the actual value of fixed assets. And then they have told that there is a machine which is sold for 25,000. So that value is 70,000. That means depreciation is 30,000. So depreciation is 30, sold for 25. So there is a loss of 15,000 as I told, which will be profit and loss account. So like this you have to do. And then provision for depreciation and machinery, fixed asset balance closed down you have to write. Okay, balance you have to write. So then credit side, so you get a balance of 2,20,000, and that becomes bank account or purchase account. Okay, purchase of fixed assets. Then it is preference share capital account. There is a depreciation, redeemed preference share, balance brought down 2 lakh rupees. and then balance carried down 1 lakh rupees, and then they have told that it is sold at 5%. So 1 lakh, we will see that adjustment once again for clarity. Preference share was redeemed at value premium of 5%. So they have not given the amount. So we will see preference share capital amount. So it is 2 lakh and 1 lakh. That means only 1 lakh is redeemed. So redeemed 1 lakh in the sense for 5% of 1 lakh. Preference premium 5,000, and then redeemed value bank account. See, it is 1 lakh 5,000, and balance carried down as usual. That 1 lakh rupees you have to write. So here it is for preference share capital. Then provision for depreciation. Anyhow, I told we have added into fixed assets, and then we have to prepare that account also. So balance brought down 1 lakh 50 and 1 lakh 90, and then that 70,000 of this one you have to take, 30,000, sorry, not 70,000, 30,000 of machine, that information they have given, you have done it in fixed assets account. See, 30,000 that you have to take. So if you take that, you will get the balance 70,000, and that is the total depreciation calculated for the year. So all the adjustments with regard to the problem is done here. See here, depreciation is over, preference share capital is over, dividend, there is no provision for a dividend account, so directly you can do that dividend. Provision for depreciation is done, stock which is valued also taken into account. So all the adjustments are done. We have to prepare adjusted profit and loss account. So balance brought down first you have to write, then all the adjustments. So now fixed assets, you have 15,000 loss, that has to be written. Then provision for depreciation, you get 70,000, which includes that depreciation of 30. So separately you can't take that 30. So total 70,000 will come. Premium of dividend, premium 5,000 rupees is there, preference share capital, and then dividend they have told 15%. So 15% of 3 lakh equity capital you have to calculate. So 15% becomes 45,000. Then discount on debenture. So there is one balance sheet item, so we will see it. Equity capital later we will see. For there, debentures is taken into account. Here discount on debentures is there, 10,000 and 5,000. So that difference of 5,000 you have to take it to adjusted profit and loss account, debenture. And then opening stock, that 10,000 is there. Remember that 10,000 they have told, they have not taken into account for that. So that has to be taken into account. That's the income actually. So income which is not taken. So then you get the funds from operations, not fund flow operation. Funds from operations is 29,000. So that becomes the first statement. Of course, yes, balance carried down. Balance carried. Oh, in this problem now there is no profit and loss account. So when there is no profit and loss account, remember reserve has to be taken as a profit and loss account balance. Okay, if there is no profit and loss account, reserve has to be taken. So now funds from operation is done. Then sale of fixed asset 25,000. I told equity share capital there is a difference of 50,000, that has to be done. Debentures are issued fresh, that we will see 1 lakh rupees. Purchase of fixed asset 2 lakh 20 in the fixed assets balance it has come. Redemption of preference dividend. Now we have to take that dividend, you see, application paid, it is 45,000. Redemption of preference shares, again it is paid 1 lakh 5,000. Purchase of investment 50,000, and then we will see the problem once. So equity capital 3 lakh 50 taken. Preference capital 1 lakh 5,000 taken. And debentures 1 lakh and 2 lakh. So 1 lakh is extra taken, that is taken into account. Reserves profit and loss account sariyagi samanavagide. Provision for doubtful debts and current liability is already taken. Fixed assets is taken, account prepared. Investments 30 and 80, no adjustments, that means 50,000 is added for investment. that is taken into account in additional investment of 50,000. current asset discount on debentures. machines ಇದಾಗಿದೆ, preference shares ಆಗಿದೆ, dividend ಆಗಿದೆ, provision for depreciation ಆಗಿದೆ, stock ಆಗಿದೆ. So ಈ ರೀತಿ all the items are taken into account. Now you get a balance of 45,000 in the application side, which means it is increase in working capital. So this way one more funds flow statement is problem is solved. Thank you very much.